Alright, despite the volatility witnessed this year, Indian equity benchmarks are trading at a premium to its long-term averages. But the performance of the index constituents tell another tale. Yash Upadhyay is standing by with that story. Yash.
Good morning, Good morning, Devina. So we've been talking about how the index for the last year and a half has been managed on account of the moves that we've seen for some of the index heavyweights. And the same holds true when it comes to the Nifty valuation as well. Relative to most of its Asian as well as global peers, India continues to trade at a premium. And that has been something that has been discussed widely, despite of the fact that we've seen the kind of rout in the broader markets as well. So if you take a look at the 12-month forward price to earnings multiple for Nifty, that stands at almost about 18 times versus its 10-year historical average of 15 times. So that means that the Nifty is trading at a hefty premium of almost 16% to its long-term historical average. However, if you take a look at the individual constituents and almost two-thirds of the Nifty 50 stocks, they are trading at a discount. So 37 out of the 50 Nifty stocks are trading below their historical 10-year long-term average valuations. One is flat, while only 12 stocks, and largely they are from the FMCG space, they are trading at a premium. Essentially, what we've done is that we've looked at, we've put all of these 50 stocks into three buckets. X financials would be in the price to earnings multiple, financials would be in the price to book, and the two telecom stocks and Ultratech Cement, they fall in the EV to EBITDA valuation parameter. The reason for this big valuation premium that the Nifty has is mainly on account of the five index heavyweight stocks, the HDFC Twins, Reliance, SBI and ICICI Bank, and these are the names which continue to trade at a premium and continue to do well, pushing the Nifty higher as well as the valuation parameter. Now coming to the individual stocks, and we'll start first with the stocks for which the price to earnings multiple suits well. And what stands out here is the fact that most of the FMCG names, they continue to trade at a premium, with one exception that we'll talk about later. So HUL, Asian Paints, Titan, Britannia and Reliance, they are the top 5 stocks in this list who continue to trade at a premium, while majority of the Nifty constituents, they trade at a discount. This is followed by the likes of Tata Motors, Tech Mahindra, TCS, Hero MotoCorp, largely the autos as well as the IT pack as well. Next on the list is basically your metal names as well. So there is the likes of Vedanta, Tata Steel, Hindalco, the utility names as well, with Power Grid, NTPC. ITC is one name that I was referring to from the FMCG space, which is the only one in the Nifty which is trading at a discount. So it's down almost 36% to its 10-year historical average. On the other hand, also most of the pharma counters, they are trading with steep cuts or at a steep discount to their long-term historical average. You can take a look at Cipla, Dr. Reddy's, Sun Pharma. They are down almost anywhere between 40 to 55% to their 10-year historical average. Grasim, ONGC, the oil marketing companies, they too have been beaten down significantly in this period. One of the key highlights that stand out over here is the fact that most of the FMCG names, while they are trading at a premium, are the only exceptions, while all of the other sectors like the metal, IT, pharma, OMCs, they remain in a discount, but the leaders in those packs, they trade at a premium. So Reliance from the oil marketing companies is the only one that is trading at a premium. So that is something that the leaders are doing very well in their respective sectors. Moving on to the financial space, and again, most of these names are trading at a discount compared to their long-term historical average. So we are using the price to book multiple for financials over here, and there are the exception of Bajaj Finserv, ICICI Bank and Kotak Bank, which are trading at a slight bit of a premium. But take a look at the likes of Axis Bank, HDFC Bank, IndusInd Bank, Bajaj Finance. These are large banks with very healthy balance sheet as well. There are no as such corporate governance issues or asset quality issues. It is generally the slowing economy and concerns with respect to lending going forward, as they are directly linked to the economy. So macroeconomic concerns is the reason why we are seeing this. The last two names, Indiabulls Housing Finance and Yes Bank, well, we've known quite a lot about the concerns with respect to these two stocks. So that is the reason why they trade at such such a steep discount to their long-term averages. And the last bucket is the telecom and Ultratech Cement, which is the only cement name in this pack, and we're using the EV, the estimated EV to estimated EBITDA for this parameter. And only Bharti Airtel is trading at a premium, but again, that is a minute 0.6% premium. The other two trade at sharp cuts. So this is how the overall valuation pack remains. There is this dichotomy. While the Nifty is trading at a premium, 2/3 of the Nifty constituents, they continue to trade at a steep discount.
All right, that again points to a bit of polarization that some of the top heavyweights on the index have. Yash, thanks very much for taking out the time.